Over the last couple of weeks, a number of our major banks have predicted the biggest housing crash in decades. Will they be right? Also, inflation has increased in the United States. Is that going to happen in Australia? What does that mean for interest rates in our property markets? Now, that's what I discussed recently in my weekly Property Insider video chat that I have with Australia's leading housing economist, Dr. Andrew Wilson. And today's podcast is the audio track of that video. Now, you don't really have to watch the video. I think we're going to get our message across really well, but why not go across to YouTube and look for my Property Insiders video channel. I'll leave a link in the show notes so you can get our regular weekly insights as well. But in the meantime, enjoy today's podcast where we discuss the major banks' predictions and I'll give you a spoiler alert, why they're going to be wrong.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
In the past week or two, 3 of our 4 major banks have changed their outlook for house prices. They're now predicting the biggest house crash in decades. Will they be right? Economists at the Commonwealth Bank and National Australia Bank are forecasting house prices to fall 10% next year. And Westpac's suggesting that house prices could only fall 7% next year, but they're going to keep falling 5% further in 2024. Now, these forecasts, of course, predicted on the basis of an assumption that the Reserve Bank is going to be raising interest rates later this year, and our housing markets are going to end up being collateral damage in the Reserve Bank's efforts to keep inflation within its target in the medium term. But how likely are these forecasts to come true? That's one of the topics I'm going to be discussing today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yes, good morning, Michael. And it wouldn't be another week without some more heroic forecasts from the banks in regard to the outlook for house prices. But all will be revealed, and particularly, of course, the back end to all of this is higher interest rates, and that's the basis of these forecasts. When we do look at the historical record of house price declines, and we look at that ABS as the standard measure, and we measure from December quarter to December quarter, so that's annual changes. We see that the worst performance was in 2018 when national house prices declined by 5%, and the previous most significant declines were 4% in 2008 and another 4% in 2011-12. And both those declines, 4%, and then national prices, of course, state and capital cities typically, of course, have different outcomes according to local factors. But both those declines in 2008 and 2012 came after a lengthy period of higher interest rates in a significantly booming economy. And we're going to have to see that, really, if we're looking at the easy part of analytics, and that's the historical record, to be repeated, but not just repeated, but these banks are predicting the steepest decline in house prices in Australia's modern history. So, wow, let's see how that one works out, Michael.
Well, they don't have a really good track record of housing market forecast, Andrew. I remember 2 years ago in March 2020, when the same economists who are making those, well, let's call them interesting predictions today, they similarly predicted double-digit falls of house prices to occur then. And that didn't eventuate. They underestimated the strength. They underestimated the resilience of our housing markets. Then this time last year, the same economists, they were late to the party, and only after our property markets had turned the corner almost 6 months earlier, they realised what was really happening on the ground, and they forecast strong price growth for 2021 last year. However, once again, they underestimated the strength of our housing markets and the strong price growth that ensued. But if house prices do fall by the amounts predicted this time around, that'll make it the biggest housing downturn in modern history. Now, sure, we've seen various segments of the housing markets suffer significant price falls, certain states, certain sub-markets, but we've never seen the overall Australian house market crash like this before, have we?
Well, no, and that's that explanation regarding that the annualised or the annual calendar year changes to house prices according to the ABS quarter to quarter, December quarter to December quarter, have shown us that 5% was the worst we'd suffered. And only 3 occasions have we had a decline in national house prices. And even as we've just said, Michael, they were following a lengthy period of higher interest rates. And I still think we've got a lot of water to go under the bridge in terms of getting our economy in a normalised post-COVID environment. And a lot of what we're seeing now, we're using as the ammunition for forecasts of higher rates are really factors that are reflecting what we've gone through over the last 2 years through our COVID restriction. Most of the inflation is coming from COVID-related factors, that is of higher fuel costs, which are basically supply line constraints, and similarly house building costs, which are a result of the stimulus package from the government flooding our housing markets with new contracts for houses. And we obviously don't have the labour or materials to support that in the shorter term. But we're back to normal in terms of what's coming through the pipeline now in terms of building approvals for houses. Eventually that will stabilise. But, anything for a headline, Mike.
Where are they getting them? But let's be clear, the Reserve Bank doesn't want the house market to crash. It wants it about as much as it wants another strain of coronavirus. Of course, currently the Reserve Bank interest rates are low. They're low to bolster the economy, to stimulate inflation, to increase wages. But once the Reserve Bank believes inflation is comfortably and consistently within its desired range, and once it believes unemployment is low enough to increase wages growth significantly, then it'll raise rates, but not to levels that are going to slow the market down. It's really just going to raise them to neutral rates. That's not going to be a very high rate of interest increase this time, Andrew, is it? Because of the indebtedness of Australians.
Well, I don't subscribe the sort of the neutral. There is some sort of a magic interest rate level, which is neither too hot nor too cold, if you understand.
A Goldilocks. That's a Goldilocks interest rate.
Yes, I think everything changes, Michael, and what the neutral rate is through this cycle or this decade is different to, sensibly, logically, it should be different because things change, not just through COVID, but other changes that we have in our economy and in our society. And that means that the nature of monetary policy should be viewed as a movable feast, not something that's written on stone tablets that will never, ever change. The 10 commandments of economic policy, because those that have followed those over the last decade have ended up with a lot of egg on their face. And we need to understand that this is a moving environment, that things change. It's an evolution of economic policy, and economists are not regarded as being those that are flexible in their thinking, I think, Michael, and that's the problem, that they believe these are rules that will never change. And we've seen significant change in those economic rules over the last decade.
Well, while falling interest rates have obviously stimulated demand, they've given borrowers extra capacity, they've increased housing affordability, rising interest rates don't necessarily cause house prices to fall, do they, Andrew, unless they get up very high and after a while. That's where I think these predictions are wrong.
And the circumstances of the market are similar in terms of what we've seen, the impact with higher rates and lower house prices. And now, we're seeing a very strong period of housing market activity and higher prices, which really was a catch-up market from restrictions through COVID and pent-up demand being built up. That pent-up demand's being released. Affordability barriers are rising. It's almost a sort of a natural stabiliser that's acting on our housing markets at the moment. Banks forget we're going to see a surge. Economics basically should be about the basic fundamentals of supply and demand. That really doesn't change going forward. And what we're going to see is an environment in Australia's housing markets where we've got significant undersupply, and we're going to see a surge in demand. Now, that undersupply is evident on any measure you use, particularly given house rents going through the roof at the moment. But on the demand side, we're about to reintroduce hundreds of thousands of migrants into this country. For goodness sake, bank economists, where are they going to live? If we're not building enough houses now, and now we've got a flood of migrants coming back into the country from 0 to 200,000, surely that's going to put upward pressure on house prices, regardless of interest rates.
Well, the commentators are concerned that rising interest rates are going to cause mortgage defaults. Remember, last year there was a number of cliffs we were going to fall over, but in general, Australian households are richer than they ever have been. The strict lending criteria from the banks mean that those who borrowed over the last couple of years have got a buffer of at least 2% and now maybe even 3% for a rise in rates, which is unlikely to happen that high. And the other thing I find interesting is that most Aussie households, many Aussie households, have actually taken advantage of the low interest rates, Andrew, and they're 3-4 months ahead in their mortgage repayments. Mortgage stress isn't really on the radar at the moment, is it?
Well, whatever happened to the debt bomb, Michael? Do you remember the debt bomb? Well, that was an exciting headline for a while. For the last couple of years, we've been scared out of our wits by the imminent debt bomb. Well, we don't hear about that anymore. That's a done deal and a sad old headline that is a little embarrassing for those that promoted it. But you're absolutely right. If anything, Australians are becoming more conservative in their lending activities. And the Reserve Bank governor, as I said, I believe that they've got up to a 2-year buffer on their repayment capacity. The whole point is, why would you have higher interest rates if your economy is ticking over quite nicely and if your inflationary process is due to one-off events such as COVID lockdowns? But at the end of the day, our rates are so low that perhaps just to assuage the markets, and maybe the Reserve Bank governor is under pressure, he might just tickle those rates up from basically 0 to just above 0, and then everybody's happy. But I don't think that's going to have much of an impact on house prices, and we can see that in the latest auction results, Michael, that particularly the Melbourne and Sydney markets that had slowed down last year, they're back up and running this year, and maybe that's a bit of a surprise to some.
Yes, the market started very strongly. I think the other thing that could cause a housing market crash is severe unemployment and people not being able to keep up their mortgages. But I mean, the economy, as you say, is bounding along. Unemployment rates are low and there's prospects of wages growth ahead. So I can't see households having any mortgage stress. But the other thing that's come up recently, of course, is the inflation in the United States at 40-year highs. And so people are saying Australia's going to follow. Is that a logical conclusion?
Well, why should it? I mean, inflation is in the US is well ahead of Australia's inflation rate. Reserve Bank governor has conceded it's completely different, the environment there. But it's the matching of inflation with wages that we need to watch, because as workers chase higher prices, they bid up their wages, which therefore can act for producers to bid up their prices. So you get into a wages prices spiral. But our wage response to prices is typically a lot stickier than the US, which follows inflation upwards in a more real-time environment. Their issues are the same in the US, fuel particularly. It's just that their wages are responding in a much more significant manner. We will see the wages index out next week, so that'll be the starting point of all these predictions of higher rates. But the Reserve Bank governor has indicated that he might not just be looking at that wages index, which is a little bit questionable in terms of what he considers to be wages growth in the economy. But if we look at interest rates in the US versus interest rates in Australia, and of course that's been another bit of a furphy in terms of, well, if interest rates rise in the US, given, as I've said, they're completely different circumstances in terms of inflation and wages, but given they do rise, and they are certainly more likely to rise in the US than Australia, why wouldn't Australia follow it? Well, the answer clearly is no. When we look at the relationship between US official rates and Australia's rates, they don't respond at all. We had a significant drop in the GFC globally in interest rates, and then Australia's rates went through the roof when we had mining boom number 2, as America moved into the, as they call it, the Great Recession, and they had zero interest rates right through until 2015. Now, our rates started to fall from 2012 onwards, so we were going down when the US was flat. But then in 2015, the US put rates up quite significantly over a significant period of time. At that time, we started to cut rates again. So we were moving in the opposite direction. And then the US started to cut rates and our rates were steady through that period. So it is about local factors, and it's a very simple chart to look at, Michael, to compare US rates with Australia's rates. And you can see there's no quid pro quo in terms of the relationship. Local factors do determine what's happening at the end of the day, but as we've seen in the US and Australia. But of course, when we do have significant global forces working, such as the GFC or COVID, of course, everybody's moving in the same direction in that environment. But we don't typically also see, certainly in the modern era, a global boom in activity that pushes up rates. Again, we'll see interest rates likely rise sooner rather than later in the US this year, and perhaps Australia will move upwards, but its relationship is certainly a lot different to Australia in terms of the key drivers of interest rates, and that's inflation and wages. The autumn market.
Lots of news still coming up, so we'll be chatting each week. But I think the message from our chat today is don't lose any sleep. Don't worry that the housing market's going to crash and the value of your home is going to plummet. Would that be a fair assumption?
Yeah, absolutely, Michael. And I think this is the point that we can sit here and talk about the validity of these forecasts. But these forecasts will change once the factors that they're relying on change. If they don't pan out, the high interest rates and higher wages don't pan out. All the banks will say is the data didn't support our position. We thought it would, it didn't, so we've changed our forecasts. We've seen forecasts up and down like the weather from the banks over the last 2 years. So that's fine. But the whole point is, other than questioning, it's their business, the housing market, you'd think they'd try to get it right once in a while, wouldn't you? But the other point to that is, you don't want to be making significant long-term financial decisions based on these types of volatile forecasts. To have a much more rational approach to your business forecast in regard to the housing market, and certainly be looking at a more reliable model of outlooks for housing. And the real reliable model for housing, Michael, is just to look at the long-term journey of Australia's housing markets, and just about second to none, I believe.
Great. Look forward to catching up again next week, Andrew.
Thank you, Michael.
In a moment, I'm going to share my mindset message with you. But before I do, I just want to clarify something about my discussion with Andrew Wilson a few moments ago. And while we don't see a housing market crash, clearly the markets in 2022 and 2023 are going to be very different from the last couple of years. We're not going to have such strong property price growth. That's unsustainable. Also, the markets are going to be more fragmented. Over the last year or so, almost all properties went up. Well, almost all properties other than the inner city apartment market. But now with affordability constraints, we're having a two-tier market where the more affluent inner suburban areas of our capital cities are going to outperform regional Australia and the outer suburbs. I guess what I'm trying to say is that you can't just pick any property and hope it's going to be an investment-grade property. Sure, the markets are still moving on, but not all properties are going to increase in value at the same extent. So now, more than ever, correct property selection will be critical, and you can trust my team at Metropole to provide you with direction, guidance and results. By the way, we don't sell property, and that's why our advice is independent. So whether you're a beginner or an experienced investor, at times like this, I believe you need more than just a property strategist. You need more than just a buyer's agent. You need holistic advice, and that's what my team at Metropole can offer you. And it all starts by putting a plan together. When we build you a strategic plan for you and your family, it brings your future into the present so you can do something about it now. I look forward to being part of your ongoing wealth creation journey. Just go to metropole.com.au, find out about our range of services. You may use some, you may use many of them. I'd like to be part of your wealth creation journey, as I said, metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to talk to you about why it pays to be an optimist. Look, what does it mean to be an optimist or a pessimist? In the world of philosophy, an optimist is a person who believes that good will ultimately prevail over evil and that our world is headed in the right direction. A pessimist is the exact opposite, somebody who thinks evil ultimately wins and that the world is doomed. It's just a matter of time before we self-destruct. Now, I don't think people are 100% one way or another. Most of us have both optimistic and pessimistic tendencies. For example, a lot of people have got very dark views about the future of technology or about the climate. Those same people might well be optimistic about green energy or the ability to educate others through social media. The problem is, if you look for evil, you'll find it. And that's why it's so easy to be a pessimist. If you look at the history of humanity, you'll see violence, war, injustice, inequality, pain, torture, famine. These are all negative things. I guess it's part of all of our DNA. Our ancestors did bad things. But if you believe the world's bad, you won't have a hard time finding evidence for that. There's still lots of suffering in the world. But here comes the kicker. There's less suffering now than there was 100 years ago, or in fact even 50 years ago. The world's no way perfect, but it's a little bit better than the past. Just a little bit. And that tiny bit of improvement, well, that's in my mind a case for optimism. Now, while we don't know exactly how many people are born optimists or born pessimists, I assume the latter group, the pessimists, are in the majority. It's part of our DNA, as I said. It's probably got to do with people's background as well. When life's hard, you tend to fall in a negative downward cycle. When bad things seem to happen to you and to the people in your life, it's hard to imagine things are going to get good. You need a really good reason to change your whole outlook on life. But if you can be optimistic, it's going to make your life a lot better. And that reason is the promise of a better future. When you see examples of people who've made something out of themselves from nothing, well, there you go, you've got proof. You can build a good life. You can get educated. You can become wealthy. You can become a successful investor. But you have to believe that the world's going in the right direction. To be blunt, as a property investor, you need to be bullish about the future. In my mind, one of the main reasons Warren Buffett is successful is not because he's the best stock picker in the world. Yeah, of course he's a good stock picker, but more than anything else, he's optimistic and he's patient, a combination of personality traits not a lot of people possess. While other global investors screamed fire and warned the world's about to crash and bear markets are going to plummet, Buffett's been optimistic for most of his 80 or so years of investing. And even in the 1990s, when he started receiving global fame, he repeated one thing over and over again publicly. He said, "Never bet against America." At the 2020 annual shareholders meeting of his firm Berkshire Hathaway, at the peak of the initial the COVID pandemic, he reiterated the same message. Buffett spent the first part of his meeting talking about all the good things that happened. He said, in the 231 years, nobody in their wildest dreams would have thought that in the next 3 lifetimes, the United States would have had 280 million people, that aeroplanes would fly at 40,000 feet. He said that we'd have a great hospital system. Everything has just exceeded anybody's dreams. Yes, Warren Buffett's an optimist. By the way, so am I. And in my studies, I've realised that optimists behave differently. By the way, every successful long-term investor is an optimist. Otherwise, why put money into assets? When you adopt an optimistic perspective on the world, you behave differently. You have faith in the future, so you invest in your education, you maintain your health, and you steadily invest in assets. You realise the world's going to keep improving, and you don't want to be left behind. Of course, it's a very different way of living, a very different way of thinking than the pessimists. And boy, do I see my share of those and the trolls on the internet. Over the past 20 years, look, we've seen many crises, from wars to financial collapse to global pandemic. And as humans, as a group, we've just kept improving through all these challenges. It doesn't require much imagination to realise we're going to keep improving. I've never seen a successful, wealthy pessimist, so my message to you today is be an optimist. Well, I hope you'll go to sleep better at night now, knowing that our property markets are not going to crash. If you want to keep up to date with what's happening in our property markets, you can always subscribe to my YouTube channel with Andrew Wilson. Go to propertyinsiders.info or just look for the Michael Yardney YouTube channel, and each week you'll hear the sort of discussion we've had today. Now, I'll be back again real soon, but in the meantime, you can catch me on social media. Just look for Michael Yardney. And if you got some benefit from today's show, why not tell somebody else about it as well? Help them become more financially fluent. Help me in my quest to make more people financially fluent. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?